What if I told you? The stock market isn't run by traders anymore. Not by guys in suits shouting buy and sell. It's run by machines, artificial intelligence, algorithms that don't blink, don't sleep, and never panic. Every second, billions are traded, faster than any human can think. And most of us have no idea it's happening. But in this video, we're going to show you how AI didn't just enter Wall Street, it took over. A few decades ago, markets were run by emotion. Today, they're run by code. Over 70% of US equity trades are executed by algorithms, many of them using AI, machine learning, and real-time prediction models. You never see them, you never hear them. But they're watching everything: prices, tweets, headlines, even the weather. These firms don't look like Wall Street. They look like MIT labs. At the top of this pyramid is Renaissance Technologies. Its founder, Jim Simons, built an empire not on instincts, but on equations. In fact, their trading floor? It's just data scientists and silence. So what does this look like from the inside? In the next clip, you'll hear directly from Jim Simons himself, the legendary mathematician turned trader who pioneered this data-first revolution.
And I think you're credited with doing something remarkable at Renaissance, which is building this culture of this group of people who weren't just hired guns who could be lured away by money. Their motivation was doing exciting mathematics and science.
Well, I hope that might be true, but some of it was money.
They made a lot of money.
I can't say that no one came because of the money. I think a lot of them came because of the money, but they also came because it would be fun.
What role did machine learning play in all this?
Well, in a certain sense, what we did was machine learning. You look at a lot of data and you try to simulate different predictive schemes until you get better and better at it. It doesn't necessarily feed back on itself the way we did things, but it worked. And
so these different predictive schemes can be really quite wild, quite unexpected. I mean, you look at everything, right? You look at weather, length of dresses, political opinion.
Length of dresses we didn't try, but...
what sort of things?
Well, everything. I mean, everything is grist for the mill, except hem lengths, I have to say. Weather, annual reports, monthly, quarterly reports, the historic data itself, volumes, you name it, whatever there is. We take in terabytes of data a day and store it away and massage it and get it ready for analysis. And you're looking for anomalies. You're looking for, like you said, the efficient market hypothesis.
But any one anomaly might be just a random thing. So is the secret here to just look at multiple strange anomalies and see when they align?
Well, any one anomaly might be a random thing. However, if you have enough data, you can tell that it's not. So you can see an anomaly that's persisted for a sufficiently long time so that the probability of it being random is not high. But these things fade after a while. Anomalies can get washed out, so you have to keep on top of the business.
These AIs aren't guessing. They're processing everything: market data, news headlines, tweets, weather patterns, even satellite images of Walmart parking lots. They don't sleep. They don't panic. They just calculate millions of times per second. Some use natural language processing to scan sentiment. Others use reinforcement learning to adjust strategies in real time. On May 6, 2010, the Dow Jones dropped nearly 1,000 points. In just 10 minutes, billions were wiped out. The culprit? Not fear, not a rumor, just code. One algorithm misfired, and others followed. A machine stampede, and no one could stop it. Watch this real-time footage of the 2010 flash crash, where no one, not even seasoned traders, could understand what was happening as machines took over.
The volatility in the market has been frightening.
And what is happening in Greece makes traders realize that their concerns spread around the globe very quickly.
You can see now that the Dow is down some 400 points, again at one point down about 900 points.
And our economy, our broader economy, Rick, is not fundamentally that strong yet.
May 6th, in case you forgot, was a day that many investors will remember as the day of the flash crash. A lot of panic, the Dow falling almost 1,000 points. And as fate would have it, I had Mark Lucchini from Janney Montgomery Scott here that day to talk to us. We're happy to note that the Dow is not currently down over 900 points, so you are not a bad luck charm, apparently. So to start off, the day it was happening, we were trying to figure out what the heck was going on. We both talked about the lack of confidence in the markets and concerns about Europe. We're seeing pictures of unrest in Greece. Euro fears have not gone away, but what has changed, from May 6th to now in terms of what's going on in Europe, you think?
Well, certainly that hasn't gone away completely. We did find, and we're largely right, that it was a situation of a lack of confidence, but it was also a matter of panic meeting automation. And unfortunately, all the answers have yet to be answered or the questions yet to be answered relative to what exactly contributed to that flash crash.
On Wall Street, milliseconds mean millions. One firm spent $300 million just to build a straight-line fiber optic cable from Chicago to New York, shaving off milliseconds of latency. That cable? It made fortunes. In the next clip, we explore a project so ambitious and so lucrative. It redefined the entire speed war between trading firms.
Jumping up and down. Now, I know what you might be thinking. What's adorable about the New York Stock Exchange? Isn't it a bunch of greedy capitalist pigs who profit off the labor of the oppressed and caused a massive global financial meltdown for which they were never punished? Moving on, these people, the people on the floor of the stock exchange, aren't really the New York Stock Exchange, it turns out. They're basically just a fun little theater act for CNBC because this isn't where the real trading happens. It really happens here, in Secaucus, New Jersey, and it isn't really a bunch of fun little guys in suits jumping around. It's a bunch of massive servers sitting in data centers processing millions of trades a minute, and it is for this reason why a massive, super expensive cable stretches between New York and Chicago. In the United States, the market for futures exists mainly in Chicago, the New York City of places that aren't New York City. A future, if you don't know, is like a stock, except technically it's not. It's a promise to get a stock in the future for a set price. You don't need to totally understand it. For now, just know that futures are basically made up of stocks, but most stocks don't sell in Chicago. They sell in New York. Or technically they sell in data centers in Secaucus, New Jersey, but people pretend they sell in New York because, New Jersey. Gross. So now imagine this. There's a future in Chicago made up of stock in Half as Interesting Incorporated, and that HAI stock is selling for $100 on the New York Stock Exchange, and so the Chicago future market is valuing HAI stock at $100. But then, because the world finally decides they want to know how polar bears ruined Halloween in northern Canada, our price goes up to $100.01 on the New York Stock Exchange. But here's the crucial thing. It'll take a few milliseconds for the computers running the futures market in Chicago to find out that our stock price has gone up because they have to wait for the information to physically travel through cables from the data centers in New Jersey to the data centers in Chicago. But if I can find out that the stock price went up before the Chicago market can, I can buy a future of that HAI stock in Chicago valued at $100 and then sell it for $100.01 once the price is updated, and I would, with full certainty, make 1 penny. But in order for me to execute this risk-free trade, I need to be able to find out the price in New York, or again technically New Jersey, faster than anyone else. Now, New Jersey and Chicago, for a while, have been connected by a high-speed internet via fiber optic cable, but that fiber optic cable isn't in a straight line, mainly because it runs into the Allegheny Mountains in West Virginia and has to sort of snake between them. If I want a faster connection, I'd have to make the cable shorter, but what am I going to do? Build a perfectly straight 827-mile tunnel all the way from Chicago to New Jersey, boring through mountains and under rivers so I can lay a single 1.5-inch thick piece of fiber optic cable across the eastern United States? Yep. I want my risk-free pennies, so that's exactly what I'm going to do. At least it is if my name is Dan Spivey, founder of Spread Networks, which spent $300 million hiring a crew of 2,000 to dig a hole from Chicago to New Jersey. In secret, by the way, so competitors couldn't scoop him. Now, using this cable, instead of 16 milliseconds for information to go from Chicago to Jersey, it takes just under 13. That's a difference of 3 milliseconds.
Today's algorithms don't just look at price charts. They look at you, your tweets, your Amazon cart, the number of cars at your local Costco. This is called alternative data, and it's one of the most valuable tools on Wall Street. Your digital exhaust has value, and someone's already trading on it. In this next segment, a fund manager explains how social media sentiment from everyday users like you is now one of the most powerful market signals.
What is Buzz and how was it founded?
Sure, I'll take that. Buzz really started as a research project for us, and it was around this idea of investor sentiment that has been something of great interest to me throughout my career. You know, in financial markets, we hear a lot about sentiment all the time, and for most of us, we're trained to think of sentiment as some contrarian indicator. And what I found is, and what most of us know, is sentiment moves markets, right? That's happened since the first day a stock ever traded on the New York Stock Exchange. But how do you quantify it? And if it was as simple as being contrarian, why can't we always just fade sentiment and get it right? And I think one of the problems with thinking about sentiment historically was it was always thought of by way of proxy. So we think about market sentiment. We had no good way of measuring it. So we would do things like poll people, or we would look to various types of fund flows, or maybe a measure like volatility, the VIX. We're familiar with hearing about that index, the fear index, but it never really got down to the individual stock level. And where we got excited about, potentially using sentiment at that individual stock level was, back in 2014, I'd say, I noticed there was a real increase in the amount of individual investors going to online platforms and talking about stocks and individual stocks. So they were having conversations about IBM and Boeing and Disney and Netflix and all the stocks that we are, come to know about in our portfolio. And in doing so, they're leaving a digital trail. And so if we could build an algorithm to sort of monitor that conversation, for once and finally, we could actually use data to say individuals are positive on one stock and maybe negative on another, and then use that data to determine, is sentiment once and for all contrarian, or might it be predictive of good performance within stocks?
Here's the scary part. Even the firms running these AIs don't fully understand them anymore. They're too complex, too fast, too autonomous. And the regulators? Way behind. Coming up, SEC Chair Gary Gensler sounds the alarm on AI and market regulation, and how governments may already be outmatched.
And Mr. Gensler, the SEC clearly looking closer at the use of AI tools in finance. We know that from the agency's latest exam priorities. But in parallel, a year ago, you embarked on this rulemaking process. And I want to start by asking what sort of additional authority or power you feel you need through a rule that you wouldn't be able to regulate through examinations.
So let me say this. I think that the use of artificial intelligence, which has been around for at least 10 years, has taken on, and it's an important transformative part of our economy. Every bit as transformative as the internet, probably more. Every bit as transformative as 100 years ago when we electrified so many things in our markets, our factories, the automobile, the refrigerator. That transformative. In finance, it's being used today by many brokerage apps and investment advisors when they're selling to the public. Just as when we're looking at movie apps that have figured out long ago that I'm a rom-com type of guy and want to watch those movies. And so it's to ensure that in the algorithm, in the actual math of the algorithm, that they ensure that they put the public's interest, their customers' interest, ahead of the investment advisor and broker-dealer. That's it in a nutshell.
In a nutshell, do you think that there's financial systemic risk still looming large because of adoption of AI and AI models ultimately being too similar from one brokerage to the next?
I do think so. I said I like rom-coms, so I'll go with that wonderful movie Her, when Scarlett Johansson, played this virtual assistant. When she went offline late in the movie, 8,316 folks were brokenhearted. We could see that in finance. There's right now 2 or 3 large cloud providers that are backing some of the biggest investments in what's called generative AI. As the financial sector more and more relies on those big base models, it is not only possible but likely that some financial crisis in the future is that
everybody's relying on it. And whether it's like Scarlett Johansson going offline, or if Scarlett Johansson of the future, I'm talking about the AI model, is hurting and taking the capital markets off of some, various cliff. And I think that's a hard project to solve because of the dominance of a few base models likely in the future.
The endgame? A world where AI trades with AI on platforms built by AI, with minimal human involvement, an autonomous market system, efficient, ruthless, unstoppable. Autonomous agents aren't the future of finance. They're already here. Now, these agents make decisions, execute trades, and adjust, all in real time. The market doesn't feel, it doesn't fear, it calculates. If you found this eye-opening, imagine what else the machines are running that we don't see. We're just getting started. Like and subscribe for more deep dives into the unseen forces shaping our world. And as always, stay curious.